All right, before we get the start of a big data dump the rest of this week, from an economic indicator standpoint, from a retail earnings standpoint, the market had a little bit of a pause. A small range, was up for most of the day, a little bit of a selling into the end of the day. Again, probably heading into that PPI report tomorrow morning, but nothing too concerning. There is some resistance that we're at right now that actually strengthened with the extra day today from what we saw on Friday. I'm going to show you what I mean by that. But there is some resistance where we're at across pretty much most of these major indexes as we head into this basket of data that's coming out. We're also going to break down what's driving the action. There's some interesting moves today. Some pretty big outliers. On such a quiet day, we had some pretty significant outliers and some pretty interesting moves going on in the bond market. Again, relative to this idea that the 10-year dropping below 4% and that's triggering a lot of this bullishness and how likely we are to stay below 4%. So we'll talk about that. And then our trade idea is a stock that's taking advantage of the rally. It's gotten up to a really important resistance level itself in an area of the market I think is ripe for these types of trades. So we'll talk about how to trade that with our trade idea of the day. So let's go ahead and get started. Today is Monday, November the 14th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. Before we get started, I invite you to subscribe to our YouTube channel with this icon right here on the bottom right corner of your screen. There's also a red subscribe button down below the video. Click the thumbs up icon down there to like our video today. Comment on anything that stood out to you. Join our website at marketscholars.com with that link that's popping out up there. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right, including all of our upcoming classes. Come down to the bottom, click this heart, it opens up this tab, hit that like button. Same thing, click that thumbs up icon, it opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. Really helps us out, so we appreciate that. And again, we have a goal of, at least on Twitter, to get up to 100 likes. On Facebook, if we can get to 25, we got really close there. Got pretty close on Twitter as well. So remember, you can do that right now, right here, while you're watching. All right, let's get started. Take a look at the S&P 500 with the market forecast indicator. And move this out of the way here. You can see, if we take a look at how the market here, how it responded to today's move. Not surprising, the momentum line fell, the near-term line fell. The momentum line fell again to extreme lows. I mean, every time the momentum line's dipped, it's dipped down to extreme lows. Again, it's not typical. Let me get rid of this blue line now. It's not typical for the near-term line or the momentum line to fall this far when you're bullish, right? Especially not typical for the near-term line, like it did here at the beginning of November. But it's especially not typical for it to do this every single time. And we've been in the bullish move this entire time. So needless to say, when the markets are bearish, they're bearish on a short-term basis. Of course, we're still easily above the 30-day moving average by 5%. The near-term line is still easily in bullish territory. In fact, it's in the upper reversal zone. So we're not necessarily anywhere close to turning down. You can see as of right now, it held resistance. Got a big PPI report coming out tomorrow and Empire State Manufacturing. So you got a lot of economic data. You got some retail sales earnings this week as well. A lot of Fed speak. We already had both sides of the Doves and the Hawks both speaking today. So you got a lot of that going on. But as of right now, resistance is held at that 4,000 level. You can see these two lines sitting on top of each other. The 38% retracement of the long-term year-to-date decline, and then the 62% retracement of this current intermediate decline that we're in the middle of retracing right now. Of course, the Dow Jones Industrial Average is even more bullish than that. You can see here that the Dow Jones Industrial Average has shown the same kind of bearish pattern. Got a long lower shadow on Friday. It's got a long upper shadow here today as of right now. Same pattern, intermediate lines well in the reversal zone. Market sentiment's rising, getting close to coming out. That's the more bullish side of things. The more bearish side of things, you notice the NASDAQ is holding at the 38% retracement and the 23% retracement of the long-term move. So kind of one layer down from where the S&P is. The intermediate line's in bullish territory. Market sentiment line is rising, but still in lower reversal zone in a similar short-term pattern. And then finally, the Russell 2000. If we take a look at the Russell 2000 here, same thing, holding resistance at the 62/38. This is the 38 of the long-term post-COVID rally. The 38% retracement of the of this year-to-date rally is actually sitting there with a few other lines, so which is up around 1950, and right now we're kind of holding this resistance level as of right now. It's a little bit of a divergence setting up on the intermediate line. So one day into this week, a little bit of a pause from, remember, this is a pretty historic move in just 2 days, much less the last 6 weeks for like the Dow Jones Industrial Average. When you take a look at the some of the other charts here, let's look at the long-term crossover chart, and you'll notice, you got a good bullish candle here this week. We're not above the high point, but at least it is a much higher close. That's a good sign. You have the green arrow. We're not above the 40-week yet, but again, we did in August get above there for 2 weeks. We got above it over here for multiple weeks as well. Still not above it yet here, but again, good sign. We are moving in the right direction. We talked about the possibility of the weekly hull on Friday turning negative. You can see the daily hull kind of an equal high point there. The weekly hull did flip that parabolic SAR down now, and we got the move up higher. So we'll see. That's a good sign. Now that was pretty much when we peaked in March. We did get a little bit of a rally because we didn't turn bullish until we did flip it there in August and July. But here, this is kind of more like March, where we've been bullish, and now you wonder if this marks the top. Flipping that down now actually marks the top, something to keep an eye on. Obviously, looking at 3 green arrows, we talked about how important it is this week to pretty much finish the week with 3 green arrows. They keep the green shading all across the board, and you can see that's the case right now. From a long-term perspective, the S&P is still easily below its 200-day moving average. And you also notice that the point of control for the 1-year chart changed. It was up here, but since we've moved off, then now we are sitting at the point of control. So you can see there's a resistance here. There's a lot of volume. There's already a volume node, but now that volume node is the biggest node of the year. So this price, right around 400, is where the most volume in the past year has traded at. When you look at compared to all the other prices on the chart. We are in the lower, probably slightly lower half of the total value area. So now we don't have all 70% of this year's volume above us. But again, this is a pretty significant resistance, especially considering that it's stacked on top of, a couple of these Fibonacci levels that are sitting right on top of each other. The Qs, remember, is the weaker one. It's barely above its point of control, and again, flirting with some of these lines a little bit above the 50, not anywhere close to the 200. The diamond is above the 200, sitting right at its 62% retracement level here. If you take a look from a year-to-date perspective, let me activate this. So let me look at the year-to-date move here. We'll go up to that high point. And then over here, you can see we also hit the 62% retracement here. And that's where we failed, right? That's where the Dow failed when we rolled over. And we'll see if that ends up being the case again right now. As you can see, we are sitting again at the 62% retracement with the point of control still above us. A lot of volume still above us as well. And again, not as much volume down below us if we were to follow that same pattern like we saw there in mid-August. IWM looks very much like the S&P, though it's, the S&P is not quite at the 200-day moving average. This one is. Again, also at the 62% retracement of this current intermediate decline, 38% retracement of this big post-COVID rally that we've been retracing. And then you can see, again, the 200-day moving average sitting, we filled in the gaps, sitting at that 200-day with a little bit of a divergence developing on the MACD, more of a divergence developing on the stochastics down there at the bottom. Checking out some of the other oscillators, you do have Remember, we got that breakout pattern finally on the DMI with the positive indicator rallying up above 30, the negative indicator down below 17. The Qs, remember, are your more bearish, but still showing the same pattern. The diamonds have been a lot more parabolic in their bullish move. The ADX is actually up to 34 now, very, very strong. Again, showing just how parabolic that move has been and how strong the trend has been. If you look at its trend strength indicators, it is a mature trend strength, well above 80, well above 5, way above the cloud, big rate of change over 26 days. So very, very big move for the diamonds. The Qs, on the other hand, not just barely into the cloud, no trend going at all, very weak trend, sitting at Fibonacci level, and the SPY is kind of in the middle. It's through the cloud, barely above it, a little bit, and just barely intermediate trend strength, above 2, above 65. So you can kind of see it's kind of stuck in the middle of all that. Looking at the RSI, we're back below 60, we're back below 150, so just like that, not nearly as bullish as we think we are. Remember the Dow Jones is our more bullish one. It's been above 60 this entire time, kind of flirted with getting above 70. It's actually a little bit of a divergence here forming as well. And then you remember your NASDAQ 100 never did get above 60 and is also forming a divergence with the initial peak in late October above 150, but this one not getting above 150. And you also look at, again, that McClellan oscillator we look at to kind of make sure that we have the breadth to get through there. The breadth is really weakening, so it's not necessarily the best sign. And then your on balance volume is something we've been looking at as well to support this new bullish move. Give it a second to load up here. And here, let's pull up SPY to see the divergence showing up in a big way on the money flow index, and you can see the money flow itself well up above this high point from October 25th. The price is well above there, but the on balance volume is not. So again, you can see we're not quite getting, again, the last time we were in this area right around this level 400, the volume was way up here. And we're still way down here, so we're not getting as much volume on the way up as we were on the way down, and that's pretty typical to get at least before you flip the script, at least match the volume when there's still a lot of volatility. It's once you break up here is when the volume starts to taper off, and you would expect it because you don't have as much volume over here either. So it should match, but it's not. And again, seeing the divergent setup here suggests that there's an opportunity for some weakness, especially associated with all the other divergences that are showing up there. Finally, let's look at the Ichimoku cloud. Remember, we had briefly broken above the cloud. Well, again, like I said, holding this support so far. We're still in the upper quartile, so that's a good sign. But when you look at the Bollinger Bands with the Keltner channels, we are back inside the Keltner channel as well. The bands are kind of matching the Keltner channel, so we're not really getting, a new trend. Again, as you can see, kind of why I'm still kind of in that camp of I'm not really buying this bullishness, just like I didn't in August and I didn't in March. That's why I've had the bear tag on my Market Outlook tweets and posts and emails, and I get asked, why do you still keep the Market Outlook tag bearish when we've been so bullish? Well, because you saw why in August and you saw why in April and May. And I think we're running into a very similar type of pattern now here in November heading into December. Let's take a look at the volatility index here. We started down as we typically do on Mondays. You start up here on Mondays like you typically do. Then we went down, but then we rallied at the end of the day. And you can see we stayed above this 90% mark. This 90% mark as of right now still holding as a support level. Now in March we got below 85% and we got slightly below it in August. So there's an opportunity, but considering over here in March we were well below 20, in August we were just a smidgen below 20, and right now we're nowhere near getting below 20. So that might have something to do with it, as well as again the VVIX. When you look at the VVIX, it's much lower here and trying to set up a low point. in these low levels. And again, looking at its correlation, we were looking at that negative correlation with the VVIX. You can see it again, it's still slightly negative, and it's not common for it to not be strongly positive. And when it is down here, like it was in this end of March and August, briefly here in the end of February, you tend to get a little bit of a rally in volatility. Here a little bit more of a rally in volatility. Here a lot more of a rally in volatility. So again, the expectation, especially when you consider the correlation of the VIX to SPX over the last 10 days, you can see has been abnormally positive, which also would lead to a rise in volatility. So you got multiple patterns here. And we also talked about before, and I tweeted out before, that volatility has been compressing over an extended period of time, and there's been a little bit of a move to the upside, but still that's a pretty significant compression on volatility, especially with volatility not dropping itself. So not only are we setting up for a jump in volatility, but we're setting up for one at already pretty high levels that would set us, that would extend us most likely through these year-to-date peaks around 35 to 38 in that area. One more chart I wanted to show was the Arun. So let's look at the 4-week chart. We did get a new high today, so we did get up to 400, right? Almost right on the dot before pulling back. So we did get a slightly higher high and a higher low, but we closed at the low of the day, inside of yesterday's range and below last week's high point. So by getting that new high sets us up for a new, another 6 days. So, again, barring, this move over the next 6 days of the green line. Remember, we don't really worry about a break to the downside until the green line drops below 70. And so that's what we kind of need to watch. And probably by then, if we were to kind of moderate over the next 5 to 6 days, I'm going to guess it's going to be a smaller range, because remember, the range is going to tighten up here over the next so many days. Like this low point is going to move up to there. So you're going to tighten up a little bit, just a little bit on the 4-week range. And so that's going to set you up for, this to fall down probably towards the 7-8% level where it ultimately got down to before making the break down to the downside there. In this case, making the break to the upside, coming off of a really small range over here, coming off a smaller range around 5+%, and making a break down to the downside. All right, now let's take a look at what's driving this price action. You can see the dollar's been the biggest winner over the last 3 months. Commodities holding gains and yields really strong as well. Again, over the last 3 months, but let's just look at today alone. So let's go down to November, and we'll go to the 14th and just look at today, and you can see things were holding up pretty well. The Qs were up, IWM was up. It was pretty much all US equities. Despite dollar strength, gold ended up the day strong, but real estate really got hammered. Real estate down 2.5%, commodities down 1.5%, equities got hammered by the end of the day today, down 1%, relatively speaking, right, because it's smaller range than what we saw. So when we look at especially that dollar move here, let me just move this out of the way. When you look at this dollar move, you can see again sitting on that 38% retracement, a little bit of volume node 2, and you wonder how much support is going to be in this spot in this area, especially considering you're at the lowest level below the 30-day moving average, and we've been all year. Long-term bonds have been positive, but they moved up towards their 30-day moving average. MACD is positive, has had a good run, stochastics had a good run. You wonder, again, you're not breaking through multiple moving averages here. You did a couple days ago, broke above the 8, 17, and 30 at the same time, but just barely above the 30 and not really breaking through. Though you do have a big gap in volume all the way up to about that 115 level. So bonds do have an opportunity to rally. The problem is, again, you're at the 50-day moving average for the 10-year yield in an environment where the Fed's going to raise rates, right? The odds are the Fed's going to raise rates 50 basis points to 4.5%. It's 100% odds still They haven't really moved, but you still got 100% odds for 450, and you still got 100% odds for 475 in February, and pretty much 50-50 odds that it'll be 5% in February. And most likely that's where it's going to end. You can see in June you have pretty much 87% odds of 475. And then you can see by December, you hardly have any odds. You only have about 24%, 25% odds of it being at 5% by the end of the year. So you can see the futures market starting to price in the Fed cutting rates. You got these pretty significant inversions in the 10-year as well as the 3-year 3-month. I also pulled up here the spread between the 2-year and the 3-month spread. Over here, this scale is over on the right, and then on the left is the 2-year just by itself. And you can see when that 2-year rallies, the spread between the 2-year and the 3-month drops. Usually ends up dropping about the time the 2-year peaks. So it gets below 2. When the 2-year peaks, the spread between the 3-month and the 2-year drops below 0. So in other words, the market tells the Fed it's done, right? It's done raising rates, and so you're not quite there yet. Let me refresh the page and see if it's updated through today here. So it does look like it has today. There's the spread between the 10 and the 2-year. Let me just add on the right ones here. There we go. So you can see we're sitting right around what point? 0.06. So you're not quite negative as the 2-year appears to be peaking. If I look at the what we've got here, you got 440 on the 2-year. You got 426. You got actually about 14 as the 3-month is rallied. So you got about 14 basis points as we head into that 4.5% mark that the market's priced in for December at 100% odds. So the 2-year is not really going beyond that. So it'll be interesting to see as we head into December 14th meeting, because this is what kind of prices in the terminal rate, with the 3-month kind of pricing in what the Fed's at now, and then the 10-year is pricing in inflation expectations, economic growth expectations. Again, the more that the 3-month and the 2-year rally without this, then the bigger the inversion, right? The bigger the inversion between these big areas. And that's already, 39 basis points, 53 basis points. These are big levels of inversion. I also wanted to show over here let's see, I wanted to show the skew. So let me bring up the skew here. That's not what I wanted. Here we go. I wanted to show the skew. We talked about the skew as we're starting to get bullish again, should break above this moving average and really get going to the upside. As you can see, that helps get the trend going. That helps get the trend to the upside. This also takes off above its moving average once we start getting up above, and you can see that hasn't quite happened yet. And finally, the new highs and new lows index, which is we want to see get positive. You notice can't get positive. It's really flat. It got to 4 today, -4. It was slightly positive yesterday at 2. So now we're at -4. So again, really important to see from a breadth standpoint, this new highs and new lows index kind of take off to the upside. Let's take a look now at the sectors and how they moved here today. And you can see energy's been the big winner, and some of these cyclical areas have been a pretty big winner as well. But let's just look at today alone. And you can see real estate getting hit the hardest, not surprising. But look at financials and discretionary and utilities. Those are, technology as well a little bit, but those are 3 areas that typically don't go hand in hand. Utilities and financials are opposite ends of interest rate sensitivity. Real estate also on that spectrum, along with financials. Discretionary, consumer discretionary getting hit really hard. Financials and materials and energy up with communication services were up earlier in the day, then they all just dropped. It ended up finishing higher than the market, but you can kind of see how everything dropped here. As the dollar strengthened, as bonds kind of held up, as gold strengthened, and stocks fell. So a little bit of a risk-off move heading into the overnight with a new PPI report out due tomorrow morning. We've already seen the market respond very positively to the CPI report. This one's not as important, but it is significant, and you do have some other important indicators coming out over the next few days. All right, now let's take a look at our trade idea of the day. We'll take a look at Cloudflare here, kind of an internet software company. You can see it's been on a decline for most of this year, like most of these kind of technology stocks have been. It actually peaked at the end of last year, up around $200 a share. Now it's trading at 50 on a move back up to the upside. But you can also see too that we're sitting at the 50-day moving average after a strong rally in the last week, right to the point of control, right to the 50-day moving average. Broken below the 17 to 30, but not able to get above the 50. We saw this before. I've actually seen it multiple times. It looks like it's setting up for some resistance to hold in those spots. If you take a look at the 3 green arrow chart, you can see you got light green shading in the and light green shading and yellow line. We've gotten this before. Both of those times have ended up being opportunities to sell. This is a little different because the short-term sentiment's more bullish than what we saw. But again, I think it's because we have this tremendous move to the upside that you can't necessarily trust per se. Here's the weekly chart. Again, we're only a day into it. But you got a green arrow last week. You've already got the red arrow again. That's how close we were to getting the green arrow. So you're already kind of lacking there. From an Ichimoku cloud, again, great move to the upside, but still below the cloud and still no bullish trend. That's why it's like I'm not putting a lot of faith in this move whatsoever. You can see here, and pull up Cloudflare. You can see the DMI, the positive made a good jump above 25, not above 30, but got above 25. The negatives nowhere near close to dropping below 25. Again, that's how kind of bearish it is. When you look at its RSI and CCI, it's even worse. And then you look at the Bollinger Bands here, and you say, okay, well, at least it got up to the midpoint of the chart. It's got a good strong bandwidth because you get a big move. Earlier, it's actually the big move to the downside on its earnings. You got a recovery up to the point of control, but not into the upper quartile at the midpoint of its range. Again, setting up for some failure here, but not necessarily, again, how bearish we are, not necessarily the most bearish from a directional standpoint. So what I decided to do was to sell the at the money call spread. So selling the 50, buying the 55. So you notice I get a little bit more than my normal return for a bear call spread, but on half the risk and lower probability as a result of that. So lower risk, lower probability, but still a pretty decent reward and still a pretty decent probability for making at least something on this trade. It just has to drop below 50. When you look at the range of the stock over the last little bit, 50 would be right where my cursor is, and getting below 50 would get us into the spot where we need to get a decent reward. You can see there's just no volume down there because we moved up so fast. You would expect that we can move down just as fast as we head into this volume node here that we've hit in the last couple of days. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join our website at marketscholars.com for free, like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.